This is a promotional podcast for EIS Platforms Limited Trading as Growth Invest. Any comments made or opinions expressed in this podcast should not be construed as investment advice or a financial promotion. Startups and early stage businesses are high risk investments and you are unlikely to be protected if something goes wrong. Don't invest unless you are prepared to lose all your money. Hello and welcome to Alternative Thinking with Steve Dobson and Melissa Griffiths. This is the podcast that takes a deeper dive into the alternatives marketplace and exploring topical issues. Today's guest is Stuart Beaver from Cazenove Capital, part of the Schroders Group. Welcome, Stuart.
Thank you for having me.
So, Stuart, we normally kick off with a quick bio of your career to date. Could you give us a bit of an update?
I'm wealth planning director currently at Cazenove Capital, providing advice to high net worth and ultra high net worth individuals around asset allocation, what they're going to do for the next generation, all that kind of stuff. Previously worked for several other firms in this space pretty much for the last 15 years. That makes me sound old.
Very old. To the club. Perfect. All right. And so today I think we're really going to concentrate on alternatives and where you see them in clients' portfolios. So to sort of start with, what's the sort of current asset allocation strategy you tend to use for clients?
So without kind of stating the obvious, every client's treated slightly differently. It depends on the risk level that they're looking to achieve, and different parts might have slightly different risk levels. But if we talk about sort of a balanced portfolio, broadly that would be around 50% equity and then 50% other things. Of those, alternatives, which obviously everyone has slightly different definitions of what is an alternative, would be about 20%, and then the rest of it would be things like fixed interest and cash.
And we're going to move more towards the tax efficient space in particular. But with the sort of portfolios of, say, some of the more ultra net worth, could you see more exposure to tax efficient private equity markets?
So we tend to talk to clients about splitting their wealth into three buckets. The first bucket is sort of that liquidity. What cash do you need in the short term over the course of the next 1 to 2 years, and trying to get a good return on that, but physically trying to keep it pretty much as cash and almost separating it from the rest of your portfolio. You then have your lifestyle portfolio, and that might be in the sort of balanced type, growthy type portfolios where you see a lot of very traditional equities, fixed interest, all those kind of things. And then you have a legacy bucket. Now that legacy piece can be quite significant, where people have got significant levels of wealth and might not have particularly extravagant lifestyle. And so therefore you could find that those portfolios can become very heavily weighted to alternatives like private equity, etc., in order to try and give them that return for what they're trying to achieve.
Yeah. And Steve, you were going to ask as well, weren't you?
Well, I guess, what's the... if we roll back a typical client journey, if there is such a thing, with once you how do they on board, what's the first meetings, and getting to that point of assessing the kind of the risk tolerance for these particular clients.
So the vast, the biggest proportion of clients introduced to us come from existing clients referring friends and family to us. So traditionally, what happens is there's a preliminary meeting where we will talk to the family about what they're trying to achieve and what they want their wealth to do in terms of the short, medium and long term, how they'd like that to support family or otherwise, what their philanthropic objectives are, and just really get into the weeds about what wealth means to them. Once we've kind of got a bit of a steer from them about what that might look like, we will then move on to a conversation around what they've done in the past, what kind of risks they're comfortable with, what their experiences have been. And sometimes that can be a massive education for them, where people may have inherited a lot of money quite recently and they're not really aware of what it could do. They can be quite nervous, and it's just trying to educate and get them to a position where they feel comfortable. And our view would always be, take less risk than you need to start with and grow into it. Don't do too much and then regret it, because that tends to break relationships.
And I guess that's one of the hardest things, isn't it, that relationship piece? Because talking about money and kind of what you have, what you want to have, and who's included in that, they can be difficult discussions at times, I guess, for individuals, especially when they're meeting an advisor for the first time. So again, how do you get the clients comfortable with that?
It takes time.
Yeah.
And quite often we'll be the first people to have asked the family sometimes questions that what do you want this to do for your children or your grandchildren? And particularly when people haven't got grandchildren, they go, oh, I hadn't thought about that. I don't know how I want to and the impact of wealth can be quite significant, and we take that incredibly seriously because clients take it seriously, and they're worried about, if I give money too early, what impact is that going to have? If I do it too late, and there's lots of multiple factors. For us, spend time, really get to know them, and if you can almost feel you know the answer to a question before you ask it, get the answer to be what you're expecting, and you kind of go, okay, well, it sounds like we're getting close to what you're trying to achieve.
Yeah.
And it's that willingness not to accept that you know what they want yet, and take time to really go in, and it can take a long time. And one of the big bits of feedback we get regularly from clients is, you didn't make me feel rushed. It was my agenda. I moved at my pace. It wasn't trying to get me into doing something that I wasn't ready for. And that, I think, is incredibly important for us as a firm.
One of the biggest things that we're constantly talking about on the podcast is this massive intergenerational wealth transfer. And I know Octopus recently had some information coming out with statistics where they were saying that a lot of advisors are ill prepared to speak to the beneficiaries, and do need to concentrate because, and obviously that naturally leads us into tax efficient products here. But, these products often do go on to the underlying beneficiaries, who then suddenly have something that, they need to know and understand and be advised on as well. So
it's incredibly important to engage as early as you can with the next generation.
Yeah.
The data says actually, death of the main earner is historically a really high risk point for most wealth managers, where they haven't engaged even with just the spouse. And you go, well, if you're not doing that, you're kind of definitely not doing it to their children either. Children have, the data says they have quite a different investment objective. We see a lot more sustainability conversations with the 18 to 35-year-old age group than we do with the sort of 50 plus age group.
Yeah.
And that can make quite a difficult conversation where mum and dad have been running money or having money on a basis of something where the kids might not be massively comfortable about what that strategy looks like. But as a firm, that's part of our job, is to spend time talking to them and going, look, this money is for your children. They're not as keen on the strategy you're running. Should we be looking at doing something different because you don't want this to be your money?
Yeah. When I was doing a bit of research on the alternative marketplace, an interesting fact came out that it's the 18 to 30-year-olds that are really more interested in alternatives and private markets. And I think that they're probably a bit more risk-taking, aren't they? They're less vanilla, perhaps, possibly because they have access more to this space.
I think one of the things is that we live in a world now where data is available to us in far faster, far easier than it ever has been. That comes with all sorts of other risks, because there's lots of people talking about some of this stuff who don't really know what they're doing and claiming to be advisors, and the Instagram generation looking and taking advice from them. However, having said that, what they are doing is getting people to realize that there is some real opportunity in some of these spaces, which have historically not been massively well reviewed by the previous generation. And I think quite a lot of advisors have also been aware that those markets have really matured and changed through legislation, and also just purely and simply because we've got better and better data, which means that the bad players have ended up struggling to raise capital. But as we move forwards, I think incredibly likely that more and more of the next generation will look to these and going, well, there is an ability for me to get enhanced returns, but still aligning them to my own objectives. And I just want to have that conversation. Too often, I think that some of these things have been sold on the tax reliefs and not as an investment, because they are first and foremost an investment. Yeah. And then the tax reliefs are a nice sidebar. But if you get it right, they're incredibly powerful and incredibly important part of the kit bag.
Yeah, which actually leads us nicely on to sort of looking at alternatives and the tax efficient space. How would you're obviously quite keen on the tax efficient area. How would you bring this into a portfolio? What sort of clients would you look to go into it? What's the sort of strategy you use?
So quite a lot of our clients will generally be quite high earners, in excess of £300,000-400,000 a year in terms of income, which means that quite a lot of the pension type options are gone. They just simply can't put very much away. And so they're naturally looking at ways to make their income tax efficient. And there's only so much money that people need to spend, although sometimes that can be quite surprising. But
Definitely if you're me.
But that the ability to get a return that's attractive, that is in a space where they've got things that they're quite interested in, and in areas that can be sometimes quite difficult to get into a main part of a portfolio. If you're just starting out, getting access to small startup companies within a portfolio is quite difficult. Most of your traditional investments are going to be in main listed markets. So it can be quite an interesting space for people to go, actually, this is the investment story and this is why it's interesting. And we can't get away from, we're actually very good at this in this country.
Yes.
We're really good at taking ideas and making them into good businesses. And actually being part of that journey is something that gets clients quite excited. And particularly where they go, actually, I'm seeing the businesses that I've invested in growing, and that story is quite interesting. The fact that it comes with tax relief is because of the risk you're taking.
Yeah.
And if you didn't get the tax reliefs, fundamentally, we wouldn't do it. But it's quite an attractive way of getting access and giving people a nice positive return.
I think we had that when we did a recent podcast with Christiana from ESA, and it was looking, across Europe and the globe really, and looking at the schemes available in this country. And was it SEIS came up as the most productive, positive scheme out there. Secondly was globally.
Yeah.
Secondly was EIS. So the theoretically the foundations here for businesses are great. It's getting the information out there, one, to the founders so that they understand and know about it, and two, then advisors speaking to investors about the opportunities that they can have, obviously with the risks that go herewith.
We're seeing the interest in it. Now, we've seen some data recently, obviously, that the actual number of people claiming EIS relief is slightly down last year than the previous year. But we've got to remember the previous year was the all-time record year, and that's probably more a reflection of the amount of excess cash people have built up during COVID.
Yes.
And they're looking at something to deploy it in and going, actually, maybe this does feel slightly more interesting than just adding it to my portfolio. Going forwards, I think we're probably more likely to return to more sort of standard levels of EIS relief and EIS claimants. And I think it's here, and anecdotally, we seem to hear the current government seem to be quite keen to continue supporting it. And those are things, we're good at this in this country. We should be trying to continue to support it. And the amount of growth it drives for the economy is incredibly important.
So obviously the discussions you have with the clients, you talk about the kind of the asset allocation, but then this would be a separate conversation. Would that be brought into that asset allocation for the clients, or is the tax efficient piece kind of something that would be only in particular for certain clients you're chatting with?
So we don't really have as such a defined, inverted commas, rule. What we tend to sit there and goes, each client has to be treated like an individual, and you need to be able to evidence that the outcome for them is the right one. That said, we would naturally sit there and say, okay, well, if someone has crossed sort of 5 to 10 million of wealth, why are you not having a conversation with them around this if they've got sufficient qualifying income for the tax reliefs? Because we think private assets are an incredibly important part of a kit bag to have for certain clients once they've got into that sort of intergenerational wealth volume. And actually the return profile from them is attractive. Mm-hmm. And you've just got to be comfortable with tying money up for longer. And as we've talked about before, Mel, it's that liquidity is the elephant in the room. Clients need to have liquidity because surprising things happen. And if you've not done that correctly, it comes back to bite you really badly. So it's always just thinking, okay, how does this impact their own personal liquidity? And is this make sense based on what they're trying to achieve? Regularly, I'll be introduced to people who I feel have not done enough, or people who've done too much. And it's a conversation with them about, these are the reasons I'm nervous.
Yeah.
And actually most clients, when you talk to them and go back to those 3 buckets and go, you don't have enough of this, it makes sense. And they go, no, I get that. I've been driven by the tax relief, not because it's an investment.
Yeah. Which actually, so when we talk about liquidity, would you therefore tend to put a client towards a VCT first as opposed to an EIS fund, SEIS funds?
It's difficult. The liquidity advantage for VCTs obviously is particularly attractive, but every client's got slightly different needs. And someone who doesn't need income is never going to need income, but has a big IHT challenge. You're going, well, there's naturally this additional benefit for EIS.
Yeah.
So it's looking at the client in the round and going, okay, what do I think is the most likely good outcome for you going forwards based on your current circumstances? I think one of the challenges EIS continues to have is that following patient capital review, we're still seeing that while average hold periods might look at about 4 years, the losses massively bring that average down. Yeah. So having to hold them for longer And the client experience, if they've been aware of that and they're going into it and they understood that on the way in, is fine. More often than not, I find clients, when they get to year 8, 9, starting to go, am I ever going to get this money back?
Yeah.
Yeah. And do you see any way that can change? I mean, we've talked on the podcast about, obviously, the IPO market's been slightly depressed in the UK, so there hasn't been so many IPOs or even much exits. Really, I think they're beginning to come through. People do talk about, that being a combination of the geopolitical environment, COVID, etc. But do you think, is that something that might change in the next few years, or do you think this is the marketplace has changed?
I think fundamentally the marketplace has changed, and going forwards, I'm optimistic. I think good businesses get acquirers. It's the average business that has had some EIS or VCT money come in, and it's just difficult to get it to really show any real profitability, and sometimes the story's just not doesn't play out. And the really good managers try and get out. There are players who don't and continue to collect fees, and you then go, well, how does this look, and how is this experience as a client? It's not great.
No.
And I think one of the things we've touched on before is the data is not great. An awful lot of it is still done by spreadsheet in terms of individual client reporting, and you're taking data and having to input it, and it's very manual.
Yes.
Improving data, which I think is incredibly important going forwards. I think the KI funds will give us naturally more data because everyone's portfolio will look the same. Regularly been a problem where you've got 2 clients going on the same day with the same manager, and end up with 6 of the holdings being the same, but 4 are completely different. And it's very difficult to track and explain to them why they've had very different performance.
Yes.
But a lot of that, I think, will start to change with time and with reporting tools getting better.
Which obviously brings us nicely onto technology and obviously Growth Invest. But in terms of you use platforms across all your vanilla investments. Are you beginning to see a real demand and a need really for technology to come into this place? I mean, we've got Consumer Duty now as well.
So as a firm, we think it's incredibly important, and it's driven by customer and client outcome.
Yep.
If the client data, the worst case scenario that happens, and it has happened in the past, is a client is on the phone to their portfolio director, and they have a more accurate valuation than we do.
Mm-hmm.
And that is a very big problem very fast.
Yeah.
Particularly if we have been the recommender of that. We also then have issues which we've touched on before, where a client moves to us, they bring the previous investments with them, and they've got a lot of cash sat with a relatively small custodian carrying the risk of that, and moving that money off might not be as fast as we would like it to be. Mm-hmm. So getting on top of that and having something which makes it easier for us to be able to see and monitor, across a massive client book, when, let's be honest, client managers change jobs and leave, and they get replaced by someone new, and it's difficult to keep on top of that when it's not on your main platform. And so getting something to provide us with better data is incredibly important.
Well, and like we've touched on, I think everything's moving so fast now, isn't it? And people do move between advisors, and tech really has to come into play to aggregate everything.
And clients expect it.
Yes.
They expect to be able to look at everything they've done on your app.
Yes.
And then they sit there and go, why is that not included? We haven't got around to it. Isn't really good enough.
No, it's not going to cut, is it?
And so we currently do some stuff in order to try and to make that available to them. For us, it's not good enough. We want something that is better. We want to try and make sure that client experience is the very best that we can get on the market, and trying to make sure that that experience is so key and so critical. The data is all important. If an exit has happened, the first thing we need to be is to be on the front foot and aware of it.
Mm-hmm. Yeah.
And what we don't want to find is that a client turns up with a check in their hand and we didn't know it happened.
Yeah.
Report. And I think as well, going back to another point you made about the younger generation, what was it, the 18 to... Yeah. They're expecting it, because everything they do now is app-based, it's tech-based. So there's going to be a bigger push towards having everything in one place that they can see, whether it be a listed product or whether it be an alternative product. They don't care that it's coming from different sources. They want to be able to see it all together in a portfolio.
100%. They are quizzical, questioning, challenging on everything.
Yeah.
They take very little on face value. They want to know why. Why is it done like that? Why is it not done like this? And we don't do it isn't really acceptable.
No.
And so they'll ask questions around, what's your asset allocation and why can I not see this and why do you think this is a good idea, in a way that some previous generations just didn't. And it's just they've had it on their phone and really easy access to data.
You can get hold of a lot of this information.
Yeah. And they ask you a question and they'll Google it at the same time.
Yeah.
And just go, are you giving me the same answer? And it's because it's available to them.
Yeah.
And they've got very different, we could sit in the pub and we chat and we probably wouldn't pick up our phone mid-conversation.
No.
They've got a very different issue about that. They don't see that as a problem.
No.
And they're very comfortable looking at something while you're talking to them.
Having teenagers, I know exactly what that's like. Live life through your eyes, not the phone.
Exactly. Now, I've got some statistics here. I thought I'd see what your thoughts on these are. So ultra high net worth individuals, they think that about 50% sometimes of their portfolio can be in alternatives. They're talking over 30 million for these ultra high net worths. Do you think that's relatable?
Again, it comes down to those three buckets.
Yes.
If someone's got a relatively, 10 million is a lot of money. There's quite a lot of life you can live out of 10 million.
Happy days.
And if you've then got excess capital, you can see why you might not necessarily feel that's part of your lifestyle part. That might very well be legacy.
Yeah.
And that could very well go into much longer term investments like private assets, where you're losing some of that liquidity for that potential upside and then terms on the risk adjusted return. So there's plenty of clients who can see that being a core part of what they're doing and going, this is more what I want to do. There's an awful lot of clients who that will not be the case, where the thought of it is great. In reality, they just are not comfortable with when you say to them, you basically don't know when you're going to get this money back.
Yeah. And then I've got another here where they're talking about alternative investments rising from 13.7 trillion in 21 to being projected to be 23.3 trillion US dollars, this is, by 2027. These are figures coming out from Preqin. That's a 70% increase. Do you feel going forward, Stuart, that that's going to be, you're going to see a much bigger shift towards?
Well, we're already starting to see this. There's lots of companies coming off listed markets because they don't like having to do all the reporting and filing and all this additional cost, and actually going, but there is money that will invest in this business without us having to be listed. That, I think, is a big challenge for the listed markets, and they need to try and make it more attractive. And I think governments are starting to realise we need to make this attractive.
LSE's obviously looking at its listing requirements now. So
Exactly.
And there's some big task force. When we had Simon French on, he was discussing task force around, a lot of this regulation. There's so much red tape now with banks as well that it has meant that private markets are able to be.
It can be quite attractive when you go, this cost burden for the business is not going to exist. By going down the private, and you go, well, I can see why that's attractive. Long term, we'll see. I think the liquidity point for a business tends to be the main reason it wants to sit on a listed market, and the attractiveness of being able to get lots of investors. I could easily see that data is correct, that we're going to move to a more private assets being held because of the less reporting requirement.
Yeah.
I guess the kind of funds, we're seeing more and more secondaries trading going on with funds bringing out these secondaries target investment strategies. Do you think, again, we're going to see more of that happening?
Well, anecdotally, we're seeing more and more people talking about establishing secondaries as a way of providing founders and early investors a way of coming out of an investment. And, it's an interesting space, but when you look at the data, it seems to imply that those follow-ons are more likely to get positive returns, which is obvious, really. Following on in a good investment, you're likely to get a positive return. And so you can see why a secondary is attractive. You know, I'm more likely to get a good return, so why would I not want to participate in this? And as a founder, you might go, I just want some money out.
Yeah, well, it's taking risk off the table, isn't it?
Exactly.
One of the topics to go on to, and you kind of touched on it earlier about the ESG and the sustainability piece with the younger generation coming on the investment. Obviously, we're going to see some big changes coming in. We've had the anti-greenwashing at the end of May. We've got fund labels coming in. Funds can adopt them from start of July. By early December, they've got to have made a call whether they're going to adopt a label or not. And similar to the kind of listed versus non-listed, there's requirements that come with adopting a label. With your discussions with clients and in terms of talking around sustainability, do you see these labels, is that going to be helpful to you in terms of direction of travel, or does it change things a lot? So
we've been quite actively discussing with the regulator around how these labels need to look. Largely, and there's a particular label that we've been quite keen for them to bring out, because we're like, you know, it necessarily doesn't fit into all these buckets, and you need to just think about what you're trying to achieve. It is incredibly important. We're seeing an awful lot of charities, in particular, very keen to make sure that that label is going to fit, and we're going to still be able to retain that label following the regulatory change. I think it will be very interesting to see over the course of the next year how firms that have had the label have to have a difficult conversation about whether they can retain it or not.
Yeah.
And also those firms who might not be able to say that they are, inverted commas, sustainable, but they might have a slightly different label but still be under the similar structure but not have to meet some of the requirements. And how that lands with consumers and how comfortable they are. And you know, it's a learning journey. It's incredibly important. We think as a firm it's an incredibly important part of the investment going forwards. And it's our duty as wealth managers and custodians of wealth to think not just about risk and return, but also that long-term risk and that ESG risk. And it's an incredibly important part of just our general portfolios. I think it's going to be incredibly important. Really, really vital. And the next generation, as we touched on before, very much more focused on it and want to get really into the weeds about why and how and what is not going to be happening as much as what is going to be happening within their portfolio.
Well, it sounds like the next generation are going to make wealth managers very accountable, aren't they, really, on all, whether, you know, all the information coming in, whether it's technology or what you're advising, and as we said, sustainability. Anything else, Steve, from
No,
you?
I think that's it's been very informative, and I think we've covered a lot of topics there.
Yeah, we have. We've jumped around, but lovely to have you, Stuart.
Thank you very much for having me.
And, we hope to get you back on soon. Thank you.
Thanks, Stuart.
To hear more from Steve and I, tune in to either YouTube on video, or we're also available on all good podcast channels.